Welcome back to Balance Sheet Explained series. If you haven't watched part 1 to 4 yet about what is balance sheet, asset, liabilities and equity with example, please go check those out first because they set the foundation for what we are covering here in the part 5. In this part 5, I'll show you how to analyze balance sheet using key ratios like current ratio, debt to equity ratio and working capital, and then wrap it all up with summary so you can see the full picture. The current ratio is calculated by dividing a company's current assets by its current liabilities. The current ratio has declined slightly from 1.88 to 1.74. This means the company still has more than enough current assets to cover its short-term liabilities, but its liquidity buffer has narrowed. Possible causes for declined current ratio could be faster growth in liabilities or slower growth in liquid assets. The equation for the debt to equity ratio is total liabilities divided by shareholder equity. The ratio is unchanged, indicating a stable capital structure. For every $1 of equity, the company carries 1.46% debt, a moderate level of leverage. This suggests the company is maintaining its financing mix, neither aggressively deleveraging nor over-leveraging. The equation for working capital is working capital equals current assets minus current liabilities. Working capital has decreased by $55,000, even though current assets remained flat. But this reflects an increase in current liabilities, which could be due to higher short-term borrowings or payables. Not alarming yet, but combined with the drop in current ratio, it suggests the company is operating with less liquidity cushion. Here's what these numbers tell us. Current asset is stable, cash increased by 11%, accounts receivable decreased by 13%, and inventory decreased by 6%. However, total current asset is stable compared to 2024. So that's how professionals read a balance sheet, not just line by line, but by interpreting the story behind the numbers. If you found this breakdown helpful, make sure to like, subscribe, and share for smart, simple finance insights. In the next video, I will walk you through the cash flow statement, arguably the most important report for understanding how money moves through a business. Because profit is theory, but cash is reality. And remember, stay finwise with CPA Emma.